Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. We are recording this on Thanksgiving Day, 27th of November. So happy Thanksgiving to all of our US listeners, as well as any US listeners abroad. Hope you're having a wonderful day with family. And I'm delighted to be joined here by Lindsey Stewart, who is Director of Institutional Insights at Morningstar. Welcome, Lindsey. Great to see you here.
Hi, Ethan. Great to be on the podcast. Looking forward to digging into some insights with you.
Fantastic. Well, we're both based in London, so in the office today, and maybe if we are celebrating Thanksgiving, it'll happen after hours. But we also are based in the UK, where we've had a little bit of budget news to discuss. So let's kick this off. I'll bring up the slides. Call this podcast Feeling Well Fed, as food is on everyone's mind, whether it's the price of an average Thanksgiving basket or eating some of that food. And there's a little bit of a play on words of the Fed, because the Fed remains on everyone's lips as we look to some potential favorite when it comes to the Fed chair position. And we do know that Fed policy and likely movement when it comes to rates is definitely on the mind of the Fed today. So that's where that particular pun comes from. As usual, we will cycle through 5 topics: inflation, interest rates, equity markets, geopolitics, and other asset classes. And we're going to glance in the direction of crypto today, just to see where the risk appetite seems to be based on that at the moment, and ask us whether that tells us anything about some of the vibes and perhaps the sentiment regarding other asset classes. In terms of sub discussions today, we'll be looking at whether the economy has essentially received a pardon on some of the good news, or the bad news, should I say, that has been circulating. It does seem to be certainly surprising to the upside when it comes to the economy's performance. Again, as I mentioned, when it comes to interest rates in the US, focusing on the chair and his likely policy there. Equity markets are still feasting at the table when it comes to the bounty that many of the different sectors have been giving off. And there's a little bit more diversification and picky eating, as I've called it, but a little bit more looking down the menu to some other food groups beyond mainly AI. And when it comes to crypto, to keep the puns going, we are tails for the crypt in some cases, given some have been performing pretty badly. So here's Lindsey, Director of Institutional Insights at Morningstar. I'll let you read the rest of that there. But again, Lindsey, thank you for being with us. Delighted to have you.
My pleasure.
Well, let's kick off with inflation. So there has been a lot of focus in the US on the typical consumer's Thanksgiving basket. And the question being whether that basket costs less today than it would have cost last year. And if we look at some of the Thanksgiving staples, and this is very much like Christmas staples for any UK listener, turkey, cranberry stuffing, all of that seems to be down slightly since last year, and we're kind of getting back to 2020, just post-COVID levels. However, it's other, of course, the general consumer basket is a lot more than Thanksgiving staples. And we have been discussing a kind of a lower resting heartbeat, as another commentator has called it, of inflation at around the 3% level. And then in the UK, of course, resting even higher than that, the latest reading being around 3.6%. So, Lindsey, over to you in terms of your outlook around inflation and whether we should be getting comfort from this Thanksgiving basket, or should we be looking perhaps at more broader indicators? Do you think it's resting now at a higher rate?
I think there's a lot of evidence to suggest that inflation is resting at a higher rate in the 2020s than perhaps before the pandemic. I'm not so sure that the monetary policy environment has adjusted to that in the way that everybody might have expected. We've long talked, for example, in the UK about the 2% target rate that the Bank of England has consistently failed to reach over quite a long period of time. We've had this persistently high inflation. But looking at the Thanksgiving basket, it's possible to interpret this as a basket of largely discretionary items. However, as everything with markets, it's a matter of perspective. It's always bad news for the turkey.
Absolutely. Well, let's move on to other vibes that we're getting out of the economy. And I think before we move on, I suppose it's safe to say that the consumer, we are very focused on the pressure on the consumer from all angles, certainly the lower end consumer, because even though they may not drive markets, they are certainly an important part of the puzzle when we talk about this K-shaped economy. And looking now at the vibes, so this is actually more of a kind of a strategist look at the vibes. In the past weeks, we've looked at some of the consumer sentiment numbers, which were softer as we did expect, and sort of seemed to be in line with what we saw from the just the other sentiment we were getting out of the consumer. But when it comes to Wall Street strategists, it seems that Wall Street is 100% behind continuing bull run of the equities into 2026. So if we see, we don't ourselves at Moneta put a particular number on the S&P, but we can see that Wall Street strategists are bracing for this continued bull run past 6,500 up towards 7,000. And then when we look at the Bank of America Global Fund Manager Survey, they are equally fairly, I'd say 43% looking at a level between 7,000 and 7,500. It's impossible to pick apart where all of this is essentially coming from. Is it coming from the same concentrated names? Is it coming from elsewhere, but other more diversified names? But this seems very bullish. Does this surprise you to see this kind of positive sentiment?
It's not entirely surprising. It looks like we've been on a rather long bull run over the last year or so that looks set to continue. But I think it's also important to remember that this sentiment can also be very fickle at times. In Morningstar's latest 2026 outlook, some of my colleagues observed that the forecast for the S&P for the year started off rather high. They were all cut very significantly after what is called Liberation Day, after the tariff reactions, and have risen again toward the end of the year. But still, a lot of those forecasts are sitting below where the market currently is. So we've seen these expectations reset several times over the year with all the volatility that we've had, and I expect there will be further resets coming in the coming months. It's always interesting to watch, though.
Yeah, exactly. So I was a little surprised by this because it did seem that there was certainly in the last month. It sounds like November is finishing about flat, and we'll talk about equity markets in a second, but it did seem that more negative news, or at least concern, was coming to the fore. And just continuing on the economic discussion. So this is initial jobless claims here, 2022 to the 2025. And we can see that there is, looking at the beyond the black number being the 2025, what typically happens at the end of the year is that they will tick up as we get to the end of the year. Maybe there have been job cuts made throughout the course of the year. It's always particularly brutal to lose one's job just before the holiday season, but that does happen before bonuses are paid. And if patterns were to continue, we would expect to see things at least ticking upwards. This low hiring, low firing kind of equilibrium seems to be continuing. We don't have all the job data. As we know, there has been a bit of a blackout for at least a month in the US. Any thoughts there on whether this is likely to spike into kind of the type of crisis that would cause the Fed to act? Or do you expect kind of more of the same?
I think this slow rumbling along as everyone seeks to deal with the current policy environment is likely to continue in the short term, but who really knows what's around the corner? I think what is interesting to observe is that amid this sort of low firing activity, it really is interesting to see the focus that's being put on further interest rate cuts, which it does feel a little unusual to me.
And that's actually a good segue right into the next discussion, which is that we're feeling very well fed, I would say, in a advance of a Thanksgiving meal, in that the Fed seems to have delivered time and time again, according to expectations. And now the rumors, at least the high probability of Kevin Hassett being appointed chair, it's only the betting markets at this point. President Trump is giving nothing away. It does seem that he would be certainly firmly in favor of an aggressive rate cutting schedule. And we can see here that the stocks very much move in sync with the expectation of a Fed rate cut. You can see that on the top left. And equally that we are still kind of looking at this lenient Fed as being the dominant assumption. And I think we have to look at kind of human behavior here. We are in the definitely the twilight of Chairman Powell's era. He may be strict in his resolve not to do anything radical, but he's unlikely to, I think, surprise us in his last few months. Markets will look ahead to what's coming. And then just in terms of this, the 10-year yield seems to be down on the expectation that a set of rate cuts is coming. The number 3% has been highlighted there for him. And that seems to be that the markets have been really responding in kind. Looking at this, is this the central case for Morningstar? And what do you think this means for inflation and just economic activity generally.
Yeah, we're hearing similar things on our side. Morningstar's 2026 outlook does suggest a drift down to around 3% for US interest rates, about 3.5% for the BOE, but it's also expecting the ECB to start converging up to around the 2.5% mark. ECB being the only one who's expected to raise interest rates, but largely that cutting cycle is expected, certainly in the US and the UK, and that does have implications for the inflation environment going forward. We might yet see another rise in inflation as those policymakers seek to keep those economies going and ticking over.
And it's interesting. I think that kind of overheating concern seems to have gone on the back burner a little when it comes to rates, maybe because there was perhaps that the shock in markets around AI and over the month of November. It seems to have eased a little, but perhaps there seem to be enough negative forces that could perhaps offset a melt up type of scenario that that rate cuts would suggest. I think it's also very notable that this firmly, I think, skewed chairman that would be firmly skewed in favor of rates would be coming in an election year. And I think that there's no coincidence there. It could well be that this is designed to have a barrage of good news as we come into the midterms. And just going back to this sentiment here around Wall Street strategists, that could well be them kind of reading the tea leaves on that too. So an interesting outlook. Based on this, because we tried to bring a bit of a portfolio implications angle into this, would you be recommending in terms of the equity allocation side that equity allocations are still a significant part of portfolios going forward and not changing that?
I think we're generally in favor of not making volatile decisions and switching in and out of strategic allocations. And I think that still stands here. I think there's still a rather strong case for maintaining equity allocations going forward, but also thinking about that diversification element. Do you need quite so much in the United States? Should there be so much exposed to the current AI boom? And that's the kinds of questions that are going through institutional allocators' minds quite rightly at the moment. So there are some areas that allocators may wish to tweak, but I think there's still a strong case for maintaining that equity allocation right now.
This chart is quite interesting. It's just for this week, so short week so far, but just to show the resolve that markets have had to recover and really end November essentially flat. It has been a bit of a heart-stopping month in terms of equity market volatility and moves. And looking at this chart, what we can see is that the Nasdaq, the S&P, the Dow have all very much moved in sync, despite the fact that certain of these indices would be more tech-dominated than others. It seems that there is kind of a broad-based move in sync across equity markets, that investors are either downsizing, taking profits, or re-entering all at the same time, which is a somewhat interesting observation. And I suppose it also speaks to this overwhelmingly short nature of the correction. Any correction we see seems to be very short-lived. Equally, there's this resilience that just continues when it comes to the equity markets. One of the comments I've been kind of focused on that I've seen come out is how some of the stocks have moved, just the sizable moves in certain stocks. So even though we will be finishing November essentially flat, to see some of the large moves, not only in tech stocks, but also in, say, retail stocks. Urban Outfitters was up 17% today based on positive sales data. We can see Eli Lilly has done well based on, again, GLP-1 developments there. So still quite a bit of individual stock volatility. And we've been discussing concentration for some time. Do you have any, given you look broadly across markets and across the history, does this concentration, some of this individual stock volatility, how do you kind of frame that for your clients and in the advice you give?
I think the concentration is certainly something that has to be front of mind for investors right now. It's driven the bull market very, very high, but essentially we're getting to a point where we're seeing two different markets operating in the same room, as it were, in the United States, where you've got these mega cap, highly tech exposed stocks that are kind of driving everything upwards. And any move in those stocks is driving moves in the entire index to a greater and greater extent, with, the top 10 stocks in the Morningstar US large mid cap index, which is roughly parallel to the S&P 500, is around 39% concentration in those top 10 stocks. So you're looking at really, really big moves in very, very popular trades that are moving indexes. And so we're encouraging people to think a bit more broadly. The small cap and mid cap areas of the market haven't really been exposed to those massive moves in quite the same way. And so we think there are pockets of good value in there that investors need to be thinking about for the long term, because at these current valuations, we don't necessarily think that they are sustainable over the long term and going to drive the long-term returns that people are expecting that are implied by the current prices. So there really is a need to start to show discernment and look for value in a much wider range of spaces.
Another perfect leg up to the next slide, which is around some of this discernment that you mentioned. The picky eaters I've described, investors becoming, we know all about that at the Thanksgiving or Christmas table. But it seems that there is actually a real ability to sort of look at maybe perhaps a dispersion between winners and losers, early adopters, perhaps followers that will be able to gain market share, a sense that the AI trade is splintering as Google is challenging NVIDIA's dominance. That was very easy to see if we look at the left chart where we show the divergence in stock price performance between Alphabet and NVIDIA just in this month. Quite a stark dispersion there. One probably benefiting from the fact that it probably was underestimated and overlooked Google's AI prowess. The fact that Google has significant cash flows to fund its AI investment, and then just got quite a bit of excitement around its recent Gemini 3. And then NVIDIA, of course, coming off some of its initial hype and this $5 trillion valuation. Although it is notable that Alphabet is heading towards a $4 trillion valuation of its own. So quite significant dispersion. And certainly that's contributing greatly to its profitability when it comes to Google. So I suppose here, getting again to this market cap question, it's kind of a similar thing to the question about concentration. But when we have market caps of individual companies that dwarf that of entire countries, again, do you think this just means that clients have to think about their equity allocation as having a different kind of risk profile?
They certainly do, Ethan. I think what is unique about this particular situation we're in compared with eras in which we've had concentration before is that these giants are now so big that the average active manager would not necessarily be permitted to replicate that kind of concentration in their own funds. Having 30 or 40% of their equity allocation in just 7 stocks wouldn't necessarily pass a risk committee's approval. So they're really, really having to think about how are they going to beat the market when the strongest performers in the market are so huge. It's a tricky allocation problem for those who are having to make those decisions right now.
Very interesting. And I think it also throws into question just how much are markets efficient if we can still have a piece of information that can lead to stocks either going up 17%, as I mentioned before, or losing 10% in a day. Clearly, not everything is out there and being reflected in real time if these moves can still happen. So I think a very, as you said, probably a fascinating existential time for some of these investment committees and risk drivers. And I think let's not forget that NVIDIA may have been eclipsed by Google just in the last week or two, but it is still very much a bellwether for market reaction. And we can see that there's basically good results being bad news because they're not good enough, or just concerns. But we can definitely see that the VIX has been I think a little higher certainly than average over the last few months, and obviously spiking at Liberation Day, but ticking up as all eyes are on some of the very large players. And then this final chart is a bit like I said before, whereas we used to think that the Fed is it the Fed that's following the stock market, or is it the stock market that's following the Fed? We certainly seem to be this would suggest that the Fed's rate setting has followed the stock market. So these two things operate within a system, are not in isolation. And I think it's instructive just whether how much is being telegraphed today from the Fed is just so much higher.
Absolutely. Absolutely.
Let's bring it to the UK, because we have a different kind of economic experiment, you could say, here in the UK. We know what the Republican Party agenda has been when it comes to their lower tax regime. and lower regulation regime. Here in the UK, we are one day after the budget. I was actually sitting in Bloomberg offices this morning, hearing an analysis of the budget. The media doesn't like it. There's a sense that now with raising taxes to an all-time high, this will quench growth in the UK. It's going to lead to departures. And it basically that what the hard thing was not done, which is the cutting of welfare benefits. And of course, that is not easy to do in any part of the world. And we wouldn't have seen the US government necessarily taking a knife to that easily either. It's certainly not a popular move. But interestingly, the markets have responded relatively well. Some suggestion that the backdrop is just more clement these days. It's more, I suppose, it's looking more kindly upon the UK and comparing it to 2022, when Liz Truss had a much more volatile reception around about this time, 3 years ago. That markets were a little more precarious then than they are now. But still, it's a little bit of a surprising response to maybe could we describe it as an anti-growth budget. But as I said, maybe it's an experiment. We certainly have a polar opposite to the US approach. Any thoughts there in Morningstar or from yourself around what this means for the UK as an investment destination?
It's an interesting mixed bag, I think, this latest budget. Clearly, we've seen the Chancellor's favorite tool being deployed in terms of fiscal drag, trying to do the job that they can't do with explicit income tax rises. So I guess that has been taken very well by the market. You've seen that in the reduction in yields, that it's overall positive. But I think this budget and perhaps the one before it and maybe several before that have had something of a defensive feel to them. I feel like in between budgets, we hear a lot about focusing on growth, but I think the market has not necessarily seen that sort of front foot action on delivering growth and long-term investment that perhaps they were seeking. We're seeing a lot of fiscal adjustments around the edges, not necessarily core, not necessarily thinking about what they're going to do about the long-term productivity issue that was identified by the OBR slightly earlier than expected yesterday, and those kinds of long-term issues. So we'll have to see how that develops over the coming years.
Well, it's a fascinating parallel, actually, when you spoke about fiscal drag there, just thinking of the other, this was a microscopic a case under the microscope, which is New York City, with kind of, there's some similarities, some differences. One similarity would be the expectation that the wealthy will have an exodus now out of New York City due to potential for higher taxes, more democratic socialism at work. And that was, of course, the hype and the anxiety. And then as soon as Mamdani was elected, it seems that maybe there won't be that level of exodus because ultimately people still want to live in New York City. And I would say something similar for the UK. I think that rumors of mass exodus of high earners may be exaggerated, as that London still has a huge magnetic effect. And these things, as you mentioned, can be more done by stealth. You mentioned fiscal drag, less explicit, that they can occur over a space of time. There can be different motivations for living in a place and different ways to motivate growth, not simply the climate and ecosystem in which it exists. So I think it'll be interesting to watch. The key difference, of course, between the New York mayoral election and here is perhaps the overwhelming popularity of the mandate that the mayor seemed to get, but equally he doesn't have the tools necessarily at his disposal. So I think a very interesting experiment at work here. And then just get back to this fascinating chart that was in the Financial Times this week, and an article around geopolitics and alliances and how we think about alliances. And this was a GDP chart in $1 trillion, showing just the different blocks and the roles that they are starting to play. And I think what's very notable again is here we are speaking about the UK. Its GDP is only about 3.5 trillion compared to the US of almost 10 times that at 30. And China clearly quickly coming up the rear with a significant China-aligned bloc there. So I suppose this is more of a big picture question, but I think it is important to start to have these conversations about changing alliances, particularly as we still have geopolitical turmoil still afoot. And I think investors need to be thinking not only about US concentration, but also a new world order that could well be put in place with China, for example, taking such a large role. How are you at Morningstar thinking about, I suppose, the impact geopolitics has on investing? And are you doing any kind of big picture assessment like this?
It's certainly something that's front of mind for a lot of our strategists right now, given the huge impact that we've seen the geopolitical situation have on markets, on strategic asset allocation and tactical asset allocation this year. It's certainly something that we all need to think about. The direction that the United States is taking with regard to defense and security versus the approach that China is also taking with regard to technology and electrification. These are all huge themes that are going to play into the outcomes that investors will experience over the next 5, 10, 20 years. So it's certainly something that we encourage people to pay attention to, but not necessarily engage in volatile activity, shifting money here and there. It's definitely needs some deep thought and some long-term planning.
I certainly think we should maybe be questioning assumptions and then getting back to that systems thinking I mentioned earlier with respect to the Fed and markets. I think looking at these systems working together, one of the points that we've highlighted is that China, despite it being certainly in a different block here, its markets have still behaved in quite a highly correlated way to the tech momentum. So they may be different countries, different regimes, but still subject to the same types of equity sentiment. So maybe you do or do not get the diversification that you were thinking about. But I think I would say watch this space. We will be returning over and over again to changing geopolitical norms. And my last point, finally, to just close us out here is it's looking at the sort of demise currently of cryptocurrency and how Bitcoin has been performing. It certainly hasn't been doing particularly well. It's in a 2-month sell-off at the moment. And the other chart, the other thing shown on this chart is a meme stock ETFs. So as goes Bitcoin, so go meme stocks, it seems, which perhaps suggests that both are at the most speculative end of the spectrum currently. They're not diversifiers. They're not hedges necessarily. We never thought that about meme stocks, but we might have thought that about Bitcoin. And just in terms of we look at just some of the others performance metrics, Bitcoin does seem to have a negative year-on-year return, according to when you take that temperature there. And the interesting part is that despite decentralized finance, I thought this was an interesting chart to close us out, being the kind of the new game in town, the new regime, the new world order. It has actually dismally underperformed traditional banks in the over the course of the year. So I suppose it's a reminder not necessarily to write off the old index components, the constituents, and to be, I suppose, have a word of caution that new things take a while to season and to settle in. But for my last question, I'm throwing over to you, Lindsey. How do you view cryptocurrencies, digital assets generally at Morningstar, and where do you put them in your risk return matrix?
I think generally we'll take a long-term intrinsic view of the fundamentals. So I don't think that crypto is going to form a core part of anybody's recommendation at Morningstar for the time being. However, that doesn't mean it doesn't have a role. I think now that we've got to the point where Bitcoin is definitely established within the financial system, we've got Bitcoin ETFs, certainly investors have paid a lot of attention to it. So in this era, it's important to ask ourselves whether the current Bitcoin swoon that we're seeing, is it a reliable signal of a risk somewhere in the system? And if it is, what is it telling us? Now, I don't have the answer to that. If I did, maybe I'd be off somewhere making decisions based on that information. But it certainly is worth thinking about. Is the current fall in what is essentially a high-risk speculative asset? Is that telling us anything about risks elsewhere in the system with the AI boom and private credit tied to that? And anyone who will work that out in the near future is certain to prosper if they get their answer.
Well, a great answer there. And I think, yes, watch the space. So it just remains for me to just thank you very much. This is Thanksgiving Day. I think markets themselves have a lot to be thankful for. Markets have been more benign, certainly over the month of November, than they might have been, certainly than they might have looked earlier in the month. There seems to have been a relatively smooth reception to even experiments, as I mentioned, such as in the UK budget. And I am ultimately thankful to you, Lindsey, for joining me here and sharing your insights with us.
My pleasure, Ethan.
And thank you, everyone, for being our audience and for listening to the Markets Happy Hour podcast.